Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Here's where you are in the U.S. dollar. This is the U.S. dollar index coming down from 2003, coming down. We bottomed right here in 2008, in March of 2008. Then the dollar started rocketing up in July of this year. Got a big risk bid and a big rally, big pullback rally here. The U.S. dollar peaked right there around 90 on the U.S. dollar index and has been going south ever since. At the moment, we've retraced on this big bounce in the U.S. dollar, which surprised a lot of people. We've retraced 50% of that move, okay? From the low in 2008 to the high right here in 2009, the dollar has already retraced 50% of the move. From a standard retracement levels, we could retrace more. But here's the trigger that we're watching from a technical standpoint that you can say, hey, the dollar is back into a bear market technically. It's this level right here where 1 is on this chart, 74.31. Right now, the dollar index is at 80. So, you know, again, we're looking at about a 10%, not even 10% decline. A little less than that, 8%. Math. 7%. Thanks, Steve. A little late today. 7% decline in the U.S. dollar, which isn't unreasonable, needless to say. So we're watching this number very, very closely. This in of itself would tend to generate, as Steve can point this out, these key numbers on technical level tend to generate a lot of selling that could be supported by background negative sentiment that can really lead to spikes down. So this is what we're watching here from a technical standpoint of where this nastiness can get even nastier in terms of sentiment. And I think that's the end of my story for today. I hope some of it made some sense. But I guess the point is, a couple years ago, I put an extremely low probability of all this playing out. But at the moment, it's something that we're watching very, very closely, which in and of itself is a little scary for me.
Jack, why don't we do this? I'm going to leave this slide up for a second. I want everyone to type in all their questions, and I may have a slide or two about option plays. Let me see if I can find those. But right now, I just want to urge everyone to go to a couple places. The ISE website is a great place to learn more about the FX options market. So it's www.fxoptions.com. You can go there and learn a lot about either archives. We have articles that I've written, all kinds of stuff. Secondly, you want to go to blackswantrading.com and check out everything that Jack has. There are some free things that you could check out, and I think once you check out his free materials, you're probably going to be interested, or you might be interested in his newsletter, his paid newsletter, so you want to check that out. You can also email Black Swan at info@blackswantrading.com. So please check that out. You can get the currency currents, and then hopefully you're interested enough and you go to the currency strategist where Jack makes recommendations for different risk-reward portfolios. Let me just go through a couple of different things, and I think Jack went through it. Number one scenario would be that we see the world growth or a lot of inflation. One way to play it would be AUX, and I looked at these prices as of about 2 hours ago, so these are pretty current. You could have bought the July puts at 77 cents, even the September puts, the 120s. Now, obviously, that's a pretty big decline from 127 down to 120. That's why those options are only at 77 cents and $1.77. But if you wanted to look at an at-the-money option, that would be the September option would be 460, and the July option would be 330. So that would be an at-the-money option. It's going to have roughly a 50 delta for those option experts. And what that's really saying is that commodities are going to keep growing, and Jack talked about this, or the dollar is going to sell off. So that's scenario one. Scenario two, these are actually prices from about a week ago, but essentially what we're looking at here is an EUI where the dollar would rally. So in this scenario, you're looking for the dollar to rally in the next 3 to 6 months, well, 4 to 7 months or something like that, you could be buying calls. So you'd be getting payoff diagrams that look like this, which means if Jack's right, and when the dollar does hold, the U.S. dollar against the euro or EUI would play higher, maybe even to the 80 or 81 level, and you could buy options out into December. And they're probably even cheaper than $1.44 now. They may even be near $1 because EUI is down, I think today, somewhere in the 71 range, roughly. And lastly, if you wanted to play the commodities, but you wanted to play sort of the reverse, that the commodities were going to come in a bit, which means the dollar would rally, that would be a call option. You'd think that the dollar would rally up. So this is interesting because I made this slide about a week and a half ago at 117, and I think today, when I left the office, it was around 111. So the dollar has declined quite a bit, and Jack talked about that, this idea that the commodity currencies are going to grow again, that people are worried about inflation. And so there's a lot of ways to trade this. Why don't we take some questions? Again, please check out blackswantrading.com, email info@blackswantrading, and sign up for the currency currents. All right, let me get to, let's get to, oh, the slides weren't showing, is that right? Did you guys see those slides? I hope, Jack, were those showing those options quotes?
No, I'm sorry. I didn't know you were actually looking at slides.
Oh, darn it.
Just talking.
Hey, you had the control. Sorry about that. All right, let me just go real quickly. Sorry about that. My bad. Let me just, hopefully, I just want to show you those. So area one, can you see that, Jack?
Yes.
Yeah, so, back to the point, sorry about that, that if the world is growing in and commodities are, of course, in demand, well, more than likely the Australian dollar is going to be in demand, and therefore the dollar, U.S. dollar, would sell off. So here are a couple of option plays, buying the 128 put in either July or September. Another strategy, and I went through it, is that the EUI rallying, which means that the U.S. dollar would rally because, as Jack said, hopefully U.S. investors start to save more money, and therefore the dollar would probably strengthen, and there's some plays here. In fact, as I said, the 81 call is probably a lot less than $1.44. Lastly, if you believe that the commodities were going to come in quite a bit, you could buy a call option on CDD. This has not worked out in the last 2 weeks or so, as I said, because I think when I left the office today, CDD was trading at 111, down from 117. What that means is that U.S. dollar is worth less. So one U.S. dollar used to buy 117. Now it's only buying 111 Canadian dollars. So you could buy a call option if you thought the dollar would rally. You buy a put option if you thought the dollar was going to sell off. All right. Sorry about all that. Let's try to take some questions, Jack, if you don't mind. Jack, we have an attendee. His name's Jack, and so it's a great name. How long a time period will the dollar decline take? What do you think?
Well, in terms of how long would it take if the dollar started down, the potential for a multi-year bear market could be huge if the whole risk scenario comes into play, the U.S. credit rating, the world reserve currency stuff. And again, the world reserve currency status of the U.S. dollar, I don't think purely from a technical standpoint is challenged because there's really no other currency out there. But this basket approach could be played out for years, and it would pressure the dollar lower, ultimately people thinking there's going to be a change in the status. Have really no idea. We've seen bear markets in the dollar. The last 3 major bear markets in the dollar, or at least the last 2, not counting what this one is, if it's still done or not. The last 2 have been 7 years. We've seen 8 and 10-year bull markets in the dollar. But there's there's not a lot of history here. As I said, free-floating currencies only started in 1971. So if we see a real major shift, as a lot of people believe, of massive wealth moving to the Asian region, it could be a long, hard slug. And again, it's not our number one scenario at the moment. But if it plays out, it would be a multi-year thing from here, we would expect.
Thank you for listening to our podcast. Please visit www.ise.com/podcasts